In January 2026, silver dropped from over $90 to $70 in just 48 hours. Banks called it a market correction. But here's what they didn't tell you. This exact playbook already cost them $920 million in fines and sent 2 traders to prison. And right now, they're doing it again. Right now, as I'm recording this, something strange is happening in the silver market. While the price on your screen shows silver around $70 to $80, physical silver dealers in Shanghai are selling the same metal for over $130. That's an 80% difference between what the exchanges say silver is worth and what people are actually paying for the real metal. This gap has never been this wide in modern history, and if you understand why this is happening, you'll understand one of the biggest wealth transfers that's about to unfold in 2026. Let me take you back to understand what's really going on. For the past 15 years, a handful of major banks controlled the silver market. I'm not talking about conspiracy theories here. This is documented fact. In September 2020, JP Chase admitted to manipulating precious metals markets and paid $920 million in fines to the Department of Justice, the CFTC, and the SEC. This wasn't some small operation. Court documents revealed that between 2008 and 2016, JP traders in New York, London, and Hong Kong placed hundreds of thousands of fake orders in silver and gold markets. The tactic they used is called spoofing. Here's how it works in simple terms. Let's say silver is trading at $25. A JP trader wants to buy at $24. So they flood the market with massive sell orders at $25.50, making it look like there's huge selling pressure. Other traders see this and panic, driving the price down. Once silver hits $24, JP cancels all those fake sell orders and buys the real silver at the lower price. Then they reverse the process to push prices back up when they want to sell. They did this hundreds of thousands of times over 8 years. And this wasn't just one bank. 8 major banks paid a combined $1.3 billion in fines for precious metals manipulation between 2016 and 2025. UBS paid $5 million, Goldman Sachs paid $20 million, Deutsche Bank, HSBC, Scotiabank. The list goes on. 2 JP traders, Michael Nowak and Greg Smith, were actually sentenced to federal prison in August 2023. Nowak got 1 year and 1 day. Smith got 2 years. These guys went to jail for manipulating silver prices. Now here's where it gets interesting. All of this enforcement happened between 2016 and 2023. The manipulation they were punished for occurred between 2008 and 2016. So what's been happening since then? Well, in 2025, silver did something it hadn't done in 45 years. It broke above its old all-time high of $50 that was set back in 1980. Not only did it break above 50, it went on an absolute tear. Starting the year at $30, silver climbed all the way to $83 and 90 cents by late December 2025. That's a 147% gain in 1 year. Most analysts had predicted silver would average $32 to $38 for 2025. Citigroup's global head of commodities set the target of $32 in early 2025. They later revised it to $38, then $40. Silver blew past all these targets and hit $84. JP precious metals team predicted silver would test support levels between $65 and $68. Instead, it nearly hit $90 in early January 2026. So if the manipulation cases were settled and the traders went to jail, why did silver suddenly explode higher? Because the physical reality of the silver market finally started overpowering the paper manipulation. Here are the hard numbers. Global silver supply has been falling. In 2010, the world produced about 1,070 million ounces of silver. By 2024, production dropped to roughly 1,030 million ounces. At the same time, demand skyrocketed. In 2024 and 2025, global demand reached over 1.2 billion ounces per year. That created a structural deficit of about 160 to 200 million ounces every single year. Between 2021 and 2025, the total deficit added up to roughly 820 million ounces. To put that in perspective, that's more silver than many countries produce in a decade. This deficit didn't happen by accident. Industrial demand for silver has exploded. Solar panels now consume between 200 and 250 million ounces annually. Electric vehicles use 40 to 60 million ounces. Data centers, 5G infrastructure, semiconductors, all require silver. And unlike investment demand, which can go up or down based on sentiment, industrial demand is inelastic. When Apple needs silver for iPhone components, they can't just decide to buy less because the price went up. They need a specific amount, or their production line stops. Industry experts have publicly stated that manufacturers like Apple would be willing to pay up to $500 per ounce in extreme scenarios because the cost of not having silver would be far worse than paying a high price. A production halt at Apple would cost billions per day. Paying even $200 per ounce for silver would be cheap compared to that loss. Now let's talk about what happened in January 2026, because this is where the story gets really important for understanding what's coming next. Oh, I just want to remind you that if you want to survive this crash, one of the best options is to open a YouTube channel. And I can help you in my community with the link below. Back to before. On January 12th, 2026, silver was trading around $80. Within 2 days, it spiked to over $93. Then, in the following week, it crashed back down to around $70. The mainstream financial media called it a correction. They said silver was overvalued and due for a pullback. But here's what was really happening behind the scenes. In early January 2026, Bloomberg ran a story about something called the Bloomberg Commodity Index rebalancing. This happens once a year. Basically, when one commodity in their index gains too much relative to others, they have to rebalance the weightings. Because silver surged 147% in 2025, its weight in the index became too high. Citigroup research estimated that about $6.8 billion in silver futures would need to be sold during the first 2 weeks of January to rebalance the index. Citigroup's strategists, led by Kenny Hu, publicly stated they had never seen any outsized flow like this one in years of running the process. By calling the COMEX move unprecedented and outsized, they essentially gave the market a heads up that massive selling was coming. And guess what happened? Everyone who was short silver or wanted to manipulate the price lower used this as the perfect cover. The COMEX exchange raised margin requirements 3 times in the span of a week. This is a classic kill switch. When margin requirements go up, it becomes more expensive to hold futures contracts. Small traders and retail investors get squeezed out and are forced to sell. But here's the critical detail that most people missed. While the paper price of silver on the COMEX was being pushed down to $70, the physical market was telling a completely different story. In Shanghai, physical silver was trading with premiums of $8 to $10 over the spot price. Some reports indicated premiums as high as 50 to 80%, with actual transactions occurring at $130 per ounce, while COMEX spot sat around $71. This is what's called market decoupling. The paper price and the physical price are splitting apart. And when that happens in a commodity market, it means one thing: the paper market is about to break. Think about what this means. If you're a Chinese manufacturer and you need physical silver for your production line, you can't call up the COMEX and say, "I'll take delivery at $70. You have to pay the real market price of $120 or $130 because that's what it actually costs to get the metal in your hands in Shanghai. The same thing is happening with dealer inventories. COMEX registered silver inventories. The amount available for immediate delivery dropped by 60% in just 4 days in late December 2025. Retail coin dealers in the US and UK are reporting massive backlogs. Wholesalers are paying premiums well above spot price just to secure inventory. Some major UK dealers started offering to buy back silver from customers at prices above the official spot price, which almost never happens. Peter Schiff, a well-known precious metals investor, recently stated that if you can't get physical silver, you should invest heavily in mining stocks because they're considerably undervalued compared to the metal price. He's right. Mining companies are still valued as if silver is $30 or $40, but they're selling their production at $70 to $80 or higher. That disconnect won't last long. Here's where we get to the real plan, the thing the banks don't want you to understand. What happened in January 2026 wasn't a random correction. It was a coordinated attempt to shake out as many retail investors and small traders as possible before the paper market completely breaks. Let me explain why this matters so much. There's something in trading called the impossible triangle. In the silver market right now, you have three forces that can't all exist at the same time. One, you have massive structural supply deficits of 160 to 200 million ounces per year. Two, you have inelastic industrial demand that can't be reduced without shutting down production lines. Three, you have a paper futures market that claims to set the price based on unlimited contract creation. Something has to give, and what's giving is the paper market's ability to control the price. When industrial buyers need real metal, and there's a deficit, they'll pay whatever price is necessary. That's why we're seeing 80% premiums in Shanghai. The paper games don't work when there's not enough actual metal to go around. Now, the banks know this. They're not stupid. JP Morgan, despite paying $920 million in fines for past manipulation, is reportedly now holding massive long positions in silver. Market data from December 2025 suggests JP Morgan holds approximately 196 million ounces through COMEX positions and another 517 million ounces as custodian for the SLV Silver ETF. That's over 700 million ounces total. Think about that for a second. The same bank that was caught manipulating silver prices downward for 8 years and paid nearly $1 billion in fines now holds one of the largest long positions in the entire market. Why would they do that? Because they know what's coming. They spent 8 years accumulating physical silver at suppressed prices. Now they're positioned to profit as the paper market breaks and prices go exponential. The same pattern is playing out with other big players. Major tech companies like Samsung and Tesla are securing physical silver through direct deals with mining companies, completely bypassing the exchanges. This is called vertical integration. When Apple or Tesla locks in multi-year supply contracts directly with mines, they're essentially saying they don't trust the exchange prices anymore and they need to guarantee physical delivery at any cost. Meanwhile, what are they telling retail investors? That silver is overvalued above $70, that it needs to correct, that you should wait for lower prices. Citigroup recently said silver looks fundamentally overvalued above 70, and they see it averaging 70 for 2026. But remember, these are the same analysts who said it would average $32 in 2025. And it hit 84. Let's talk about what happens next, because understanding the timeline is crucial. In March 2026, there's a massive delivery month on the COMEX. Open interest in silver futures far exceeds the registered stocks available for delivery. If even a fraction of contract holders demand physical delivery, instead of rolling their contracts forward or settling in cash, the exchange faces a major problem. They either have to deliver silver they don't have, default on contracts, or allow prices to spike to whatever level brings in enough supply. This has happened before in other commodities. In the nickel market in March 2022, the London Metal Exchange had to halt trading and cancel trades when prices went exponential due to a short squeeze. They literally rewound time and erased trades that had already happened because several major banks were on the wrong side and faced billions in losses. The same mechanism exists in silver. If prices start spiking and major banks face massive losses on short positions, don't be surprised if exchanges halt trading or change the rules mid-game. But here's the difference this time. The physical shortage is real, and it's structural. You can halt paper trading, but you can't create silver out of thin air. Mine supply is constrained because silver is primarily mined as a byproduct of other metals like copper, lead, and zinc. When those base metal prices are low, mines produce less silver as a side effect, and developing new silver mines takes 7 to 10 years on average. You can't just flip a switch and produce more silver next month. Mexico, which is one of the world's largest silver producers, implemented regulatory changes in 2024 and 2025 that cut expected output by about 5% in affected regions. Russia's mining sector faces sanctions and capital constraints. Several major primary silver mines are near end of life, with no large new projects ready to replace them. So supply is going down at exactly the wrong time. On the demand side, every trend is pointing up. Electric vehicle adoption is accelerating globally. Each EV contains 3 to 5 times more silver than a traditional car. Solar panel installations are growing exponentially, driven by climate. Commitments from major countries. The AI boom is creating massive demand for data centers, which use silver in high-efficiency electrical components and thermal management systems. And we haven't even talked about the monetary demand yet. When inflation stays high and currencies lose purchasing power, people historically move to precious metals. Gold has been getting most of the attention, hitting new all-time highs regularly. But silver has a unique advantage. It's both an industrial metal and a monetary metal. Gold is primarily monetary. Copper is primarily industrial. Silver is both, so it benefits from both safe haven demand during economic uncertainty and industrial demand from technological growth. Central banks around the world have been buying gold at record rates as part of de-dollarization efforts. Countries like China, Russia, India, and others are reducing their dependence on the US dollar and increasing gold reserves. While central banks don't typically buy silver in the same way, the same de-dollarization trend creates demand for all hard assets, including silver. And when the gold to silver ratio gets stretched, as it has been, smart money tends to shift into silver for better relative value. Historically, the gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has averaged around 50 to 60 over the long term. In early 2020, that ratio spiked to 125, meaning it took 125 ounces of silver to buy 1 ounce of gold. That extreme reading led to a massive silver rally of 47% in just a few months. As of early 2026, the ratio has come down but still has room to compress further, which would mean silver outperforming gold in percentage terms. So let me bring this all together and tell you what the real plan is. The banks that got caught manipulating silver for 8 years didn't stop manipulating. They just got smarter about it. They switched from being short and suppressing prices to being long and accumulating physical metal. The crash in January 2026, from $93 down to $70, wasn't a natural correction. It was an engineered shakeout using the Bloomberg index, rebalancing as cover, combined with margin hikes and coordinated selling pressure to scare retail investors into selling their positions. Meanwhile, the physical shortage keeps getting worse. The gap between paper prices and physical prices keeps widening. Premiums in Shanghai hit 80%. Dealer inventories are being drained. Mining companies can't increase supply fast enough. Industrial demand keeps growing. And the March 2026 COMEX delivery month is shaping up to be a potential breaking point where the paper market's credibility faces a real test. The banks and major institutions are positioned long because they know the end game. When the paper market finally breaks and can no longer suppress prices through unlimited contract creation, silver doesn't just go to $100. Analysts like Alan Hibbard from Gold Silver are predicting silver could increase by over $100 per ounce in 2026, potentially reaching $175 or higher. Some analysis suggests that if industrial demand continues accelerating and supply constraints worsen, prices between $150 and $300 per ounce become mathematically necessary to rebalance the market. Remember what I said earlier, Apple and other manufacturers would pay $500 per ounce if necessary, because the alternative is shutting down production. When you have inelastic demand meeting constrained supply, price becomes almost irrelevant. You pay whatever it costs to keep your business running. The evidence is everywhere if you know where to look. JP Morgan flipped from short to long after paying those massive fines. Tech companies are securing multi-year supply contracts directly with mines. Physical premiums in Asia are at historic highs. COMEX inventories dropped 60% in 4 days. Retail dealers are paying above spot to buy back metal from customers. These aren't normal market conditions. These are the conditions that precede a major repricing event. And that's exactly what the banks want to happen, but only after they've positioned themselves correctly and shaken out the retail investors. That January 2026 crash from 93 to 70, that was the shakeout. They used every tool they had. Margin hikes, coordinated selling, bearish analyst commentary, index rebalancing, all timed perfectly to create maximum fear, right when silver was at its psychological peak. How many retail investors bought silver at $85 or $90, got scared when it dropped to 70, and sold at a loss? Probably millions. And who bought that silver from them at $70? The same banks and institutions who are now positioned for the next leg up. It's the oldest trick in the book. Manipulate prices down, accumulate the asset, then let it run when you're positioned correctly. The difference this time is that the physical shortage is real and accelerating. There's only so long they can play these games before the actual supply and demand fundamentals overwhelm the paper manipulation. Every fake sell-off creates more pent-up demand. Every margin hike forces weak hands to sell to strong hands. Every bearish analyst prediction that gets proven wrong destroys credibility and creates more skepticism of official narratives. We're watching one of the biggest wealth transfers in modern commodity markets happen in real time. The same pattern happened with oil in the 1970s when OPEC restricted supply. The same pattern happened with platinum in the early 2000s when automotive demand exploded. And it's happening now with silver as the clean energy transition, electric vehicle adoption, AI infrastructure build-out, and de-dollarization trends all converge at once while mine supply struggles to keep pace. If you understand this dynamic, you understand why the banks crashed silver on purpose in January 2026. It wasn't to keep it down forever. It was to shake out the weak hands one last time before the real move begins. Because when the March delivery crunch hits and the paper market faces its reckoning, they want to own as much physical metal as possible at the lowest possible price, and they want retail investors on the sidelines, scared and skeptical, so there's less competition when prices start going vertical. The plan is simple: suppress, accumulate, release, profit. They've done it before with other assets. They're doing it now with silver. The only question is whether you see it happening in time to position yourself accordingly, or whether you fall for the same narrative that kept silver suppressed for the past 15 years, even as the fundamentals kept getting more and more bullish. If this opened your eyes to what's really happening in the silver market, hit that subscribe button so you don't miss what comes next. Anyway, I just opened a new completely free community where I explain how to create and scale your YouTube business from zero with an experience with over 10 monetized channels. There I will give you all my tips and strategies to monetize and scale your faceless YouTube channel. And I will help you step by step, since YouTube is the golden opportunity of 2026. Even more than a stock, I'm waiting for you. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depend on your own decisions and actions.